Adair, thank you so much for participating in our project on the future of the global financial system. You have your experience is in every aspect of it. You have written about it. You are a noted commentator at conferences. And so there's literally no part of the global financial system that I wouldn't want to ask you about. But I think I'd like to start with some of the intellectual foundations that you have been talking about, and particularly some of the key assumptions that economists and finance people made in the period before the financial crisis. You've talked about these, and I wonder if you could identify 3 or 4 fundamental assumptions that you feel were very visibly invalidated by the events of 2007, 2008.
Well, I think there were 2 key sets of assumptions which one can associate, one with the discipline of macroeconomics and the arena of central bank policy, and the other to do with finance and the arena of financial regulation. But they bore an important relationship to one another, and I think both of them were flawed.
Okay.
I think on the macroeconomic side, we developed the belief that the achievement of price stability, defined as a low and stable rate of positive inflation, low but positive, achieved by manipulation of the short-term policy interest rate, that was really all that central banks needed to do, and that as long as we had low and stable inflation, the macroeconomy also would be stable. And indeed, in the macroeconomic models which supported that, it was as if the financial system didn't exist at all. If you look at the predominant new Keynesian models, which were the sort of workhorses of central bank policy, they are models which really don't have a banking system or a financial system within them, because it was assumed that the financial system was largely a veil, a neutral veil, which had no influence really in terms of the fundamental dynamics of the relationship between household savers and business borrowers. So that was what was being assumed on the macroeconomic and the central bank policy monetary side. And then when you switch to the finance and financial regulator side, I think there was a very strong belief that, a tendency to believe at least, that financial markets were just like any other markets, like the market for restaurants, the market for hotels, the market for car manufacturers. And in those other markets, I think it's been proven empirically that free markets are a pretty successful way of running things. And if you want a good supply of restaurants, the best thing to do is, subject to 1 or 2 health and safety regulations, let entrepreneurs get on with it, subject to the discipline of the markets and consumer choice. And we really applied that philosophy to the financial system and to the development by the financial system of ever-increasing levels of trading activity, ever-increasing levels of innovation, of securitized products, of derivatives, ever-increasing levels of leverage. And the assumption was that this must be beneficial because it was axiomatically beneficial, that more markets, more activity must be good, because otherwise the free market wouldn't support it. And I think those 2 beliefs together, the monetary policy macro assumption that all that matters was low and stable inflation, and the financial regulator assumption that whatever happened in the financial system must be to the good of the economy because it was in some mysterious way improving allocative efficiency. Those 2 together, I think, were a pretty noxious combination, because they meant that we were simply ill-equipped to understand that a financial crisis had happened. We had almost by two different mechanisms, assumed the possibility of a financial crisis away. The macroeconomists by assuming that you didn't have to think about the financial system at all, and the financial regulators by assuming that whatever happened in the financial system was axiomatically beneficial. I think this was a huge mistake, and it blinded us to the fact that in particular the steady growth of leverage both in the real economy and within the financial system, which had been going on for a period not of years but of decades, indeed really in some ways right since the aftermath of the Second World War, dramatic increases in leverage. I think they had created a financial system which was bound to have major macroeconomic effects. And I think that crystallized in a 2007 to 2008. And I think we are now living in a period of deep deleveraging, which is inevitable when we've allowed leverage to grow to too large a level. And I think we've realized that we have to bring together these disciplines of finance and macroeconomics in a much more fruitful fashion in the future, both in order to work our way out of this deleveraging and deflationary crisis in which we find ourselves, and once we've got out of that, to make sure that we don't do this over-leveraging cycle again in 30 or 40 years' time. But I think there were very deep intellectual roots to the failure in 2008.
So I'm going to come to the deleveraging in a minute, but you talk about two assumptions that are invalidated. One, the sort of be-all and end-all of price stability, and the other, the sort of the myth of free markets as applied to finance. I've also heard you talk about a third assumption having to do with the, I can't characterize it as eloquently as you said it, but sort of the illusion that growth is the ultimate goal and that everything is subordinate to that. Would you just say a word about that as well?
Yes, I think it's also important in the aftermath of the crisis for us to go back to... I thought I'd switched that off. Do we start again? I was sure I'd switched it. I'll start again on the... I think it's important for us in the aftermath of the crisis to go back to our fundamentals of economic thinking in many ways. And that includes thinking not just about the means and the policies by which we achieve objectives, but also the deep objectives of economic policy. Now, I don't think the financial crisis of 2008 was caused by what I'm about to say, but I do think that we need to think deeply about to what extent economic growth as an end per se, and limitlessly at an end per se, is the legitimate objective. I think there is quite a body of empirical evidence and logical thinking, a priori thinking, that tells us that while going from $1,000 a year to $10,000 a year to $20,000 a year are incredibly important transitions in human welfare and the parts of the world which are still to achieve those transitions. Once you get to the average standard of living, let us say where America or Britain or France had reached 30 years ago, the progression of the further growth in average GDP per capita I don't think is the most important objective. I think there are other things which also come importantly into the improvement of human welfare at that time. People may want more leisure. They may want a better environment. And even if we do grow, we shouldn't necessarily expect it to make people happier. We shouldn't expect that there is some limitless improvement in happiness. Now, the link that I would make to the financial system there is, I happen to believe that even though I don't think growth is the most important objective, I think it's the likely result of other things that I want to have. I think it's important to have reasonable degrees of economic freedom where people can make their own choices. I think innovation and creativity are good things in and of themselves. And I think if you have economic freedom and education and innovation and creativity, we will tend to have economic growth as a byproduct, even if we don't set it as the major objective. But the reason why this links to the financial crisis is this. If you had a choice between a set of policies that you thought would in some mysterious way just slightly increase the rate of growth from 2% to 2.1% by some amazingly complicated bit of financial engineering. If you had to choose between that, but that only came within stability, thinking more clearly about the objectives, saying it's more important to have a steady rate of growth than to absolutely maximize the final rate of growth. And here's the bit that really illustrates this. I mean, the cost of this recession, of the recession which has been produced by an overexpanded financial sector, is a cost which absolutely dwarfs the difference between 2.1% or 2% growth per annum. The US economy is now 14% below where it would have been if we'd simply grown at a previous level. And whereas I don't think more growth is always the objective, I think it's very important that we don't have setbacks to growth which have already been achieved. I'm uncertain that endless increase in income per capita delivers continual increments in human welfare, but I think it's absolutely clear that if you have macroeconomic setbacks and people lose their jobs or they lose their home or they have to take a cut on income from the level they've already achieved, that is very deleterious to human welfare. And therefore, I think it's very important that we define stability of the economy and the avoidance of setbacks as much more important than trying to squeeze out the last tiny little increment of a maximization of the rate of growth, which may come with environmental disadvantages, disadvantages in terms of an erosion of leisure at a time, or disadvantages in terms of instability.
So if I had to have a thread that goes through your arguments, see if this works. You're really talking about the importance of looking at the entire financial system and creating policies that impart some stability. That is, what you're saying is that if you looked at the free market doctrine, it had nothing to do with stability. The central bank policies of price stability was insufficient to have financial stability. And even the goal of growth is, in a sense, a false. It's a false promise if you have continual setbacks. So the theme here seems to be that you are in search of a set of policies that would give us much more financial stability within a growth scenario. You don't want something static. You're talking about innovation and creativity. So when you look at the plethora of policies that are being advanced today, both in terms of central banks and their willingness to pump in so much liquidity for such a long time, or the regulatory side, where there is a whole set of policies, some of which talk about financial stability. What is your overall impression here? Are we embarked on the right course for generalized financial stability, or do you feel that there are some major gaps that need to be plugged, or in fact a new direction that we need to go into?
Well, my belief is that we have made very important progress in the financial regulatory arena over the last 5 years in terms of reducing, at least for now, the probability of a financial crisis and a failure of a major bank. And we've done that by putting much more capital into the banking system, by restraining its ability to take too many risks with liquidity. We're on path to have better resolution regimes even for the biggest banks. We are beginning to take a set of measures which somewhat constrain the risks in shadow banking. So all of that, I think, compared with the extraordinary, in retrospect, fragile financial system that we had in 2007, 2008, is a major step forward. And on the monetary side, I think we have, monetary and fiscal side, I think we have taken the steps which were taken back in 2009 and subsequently, which have made sure that this crisis did not turn into another Great Depression. And that reflected the fact that although we criticize modern economics, well, actually we have learned something. We know how to avoid the catastrophic errors of the Great Depression. We didn't try and immediately produce balanced budgets right in the middle of a recession. We knew that we had to have aggressive monetary policies to stimulate the economy. And I think those have been reasonably successful policies in stabilizing the situation. My concern, however, is that these haven't addressed some fundamental issues that we still face. So on the financial regulation side, although I think we've made the financial system safer, I don't think we've really answered the question, how do we constrain the excessive growth of leverage in future? And I am now in quite a radical space. I think that to do that, we will have to take bank capital requirements to a still higher level. I think we will need much more powerful counter-cyclical bank capital requirements. I think we need to return to the policy toolkit of central banks' quantitative reserve requirements, which broadly speaking we moved away from as a real tool of central bank policy back in the 80s and 90s. And I think, and this will not be popular, we actually have to constrain borrowers from borrowing too much. I think we should have maximum loan-to-value limits or maximum loan-to-income limits. And all of that, I think, is required over the long term to stop us having another major over-leverage cycle again. I think given where we could end up with a situation where we never have or we very rarely have major banks ever going bankrupt again, but we could still go through another return to an over-leveraged real economy, which when it realized it was over-leveraged would go into the recession we have now. So we haven't really answered that fundamental point about how do we control over-leverage within the real economy. And then the other thing that I don't think we've fundamentally answered, though this one is very difficult to answer, is once you've got too much leverage, how do you really get out of it? Because if you actually look at what's happened to leverage over the last 5 years in our economies, we haven't managed to reduce it in total. We've just shifted it around. We've achieved, particularly in the US, a little bit of private sector deleveraging, a reduction, for instance, in household debt as a percent of GDP. But every percentage point of that reduction has been more than offset by an increase in public debt as a percent of GDP. And to the extent that we've achieved some private sector deleveraging in the advanced economies, we've had significant increases in leverage in the emerging economies. It's as if we sort of, we're almost on some waterbed of leverage. You push down this bit and it goes up elsewhere. And I still worry that this deflationary period of ultra-low interest rates, I support them, I think they're the only thing that we could do in these circumstances. I suspect that this will last longer than we presently realize. I mean, we know from Japan how difficult deleveraging is. Japan had a huge explosion of leverage. In their case, it was corporate leverage in the 1980s. A lot of real estate speculation by corporates who thought they'd get into this other activity alongside their core business. Comes to the crisis of 1990 to 91, and they've been 20 years in a private sector deleveraging crisis. And I think we're still, only have imperfect answers to that. Though, as I say, there are no perfect answers to that. But that is why my own gut feel has always been, right since 2009, that I tended right from the beginning to believe that this period of very low interest rates is lasting for longer than most people think. And even today, I think my own private forecast would be longer than the market forecast or longer than most people's expectations.
So carry this forward a little bit. If we have a period of low interest rates, that presumably is designed to stimulate growth as much as possible. It also causes investors to move into riskier assets. Where does the deleveraging come in? Yeah. If you just hypothesize, just for the extreme, another 5 years of low interest rates, I understand what that satisfies. But how do you how do you get to the deleveraging? What is the mechanism? And it sounds like that you are actually talking about more of a forced deleverage, which raises issues of kind of forced debt restructuring or even monetizing the debt. So could you talk a little bit about how do you do both?
Yeah, I think you're right that the policies that we have at the moment through monetary policies of very low policy interest rates, forward guidance that they'll stay low for a long period of time, quantitative easing which tries to affect the long-term interest rate as well as the short-term interest rate. I think these are required, but of course there is an irony that part of the way they work is by stimulating people to borrow money again. And if we got into this crisis with too much leverage, it's almost as if, the only way we know how to cure this hangover is to take a, bloody stiff drink and, get going all over again. So, there is an irony in that. I don't think there's a way around that. So how will we achieve deleveraging? Well, partly we achieve deleveraging if we can actually get the economy growing again. I mean, one of the most effective ways to grow, to reduce debt to GDP is to grow the GDP. It's also important that we make sure that we do hit positive inflation of 2% or so. And of course, some people, Ken Rogoff has argued that we may have to accept a period of time where there's a higher rate of inflation than we've been used to, because only through that will we have a nominal GDP growth rate which is sufficient to erode this debt. And I think that is a serious argument to think about. At very least, it's vital that one hits 2% inflation, and I think that's the lesson of Japan. Japan has now got an absolutely determined government and a determined central bank that says we are going to hit 2% inflation, we're going to do whatever required to get there, because if you don't achieve that, you'll never achieve deleveraging, because your denominator isn't growing fast enough to erode these debt burdens. But I think we may have to consider, more radical actions as well. And I think that will, in some cases, require accepting that some debts are not repayable at all. Let me, for instance, say one of the most obvious things. I think it is absolutely transparently obvious that the Greek government is not going to repay all the debts that it has to various official counterparties in Europe. There will be an official sector involvement. There will be a restructuring. With some mortgage debt, there needs to be write-offs. There needs to be ways of just reducing those debt burdens, not through erosion, but by recognizing they're not repayable. But I think there are other circumstances where we should accept that there is a permanent monetization. And the one thing I would predict is that although people endlessly go on about there's been QE operations, how will we exit it, i.e. these central bank balance sheets have expanded, how will they reduce? I'm willing to predict that a significant part of the increase of the monetary base of some of the central banks around the world will prove to be permanent. In which case one has permanently monetized government debt. I'm sure that that will be the case in Japan. And as long as we do that on a scale which is not Weimar Republic-like, but is simply the scale required to hit 2% or inflation, we shouldn't be terrified of it. I mean, let me give you an example from US history. From 1942 to 51, the Federal Reserve effectively monetized US government debt. The US government paid for the war by issuing government debt, but the Federal Reserve was totally committed to buying however much debt that was required to keep the interest rate at 2.5%. Now, quite rightly, by 1951, they decided we've got to put a stop to this at some level. If we continued this forever, it might be inflationary. And with the Fed Treasury Accord of 1951, they stopped that policy. But if you look at the Fed balance sheet, it never goes down. There is no exit from that. It simply stops going up. In which case, effectively, that government debt, which had been issued to pay for the war, was effectively monetized. And part of the war was paid for by an increase of the money supply rather than an increase of debt. And this is considered a completely taboo subject in central banking, because people are terrified that once we admit that this is possible, that we'll all turn into Weimar hyperinflationists. But actually, the history of the world does have examples of money finance deficits or post facto monetization of government debt, which has been done in responsible and contained amounts rather than in totally irresponsible and excessive amounts. If you look at how the US Union government paid for the Civil War and the immediate post-Civil War period with greenbacks, that was money finance rather than debt finance. If you look at how Japan moved out of the recession, Great Depression in 1931 under Finance Minister Takahashi, again, that was money finance. So my prediction is that this getting out of this huge over-leveraged situation in which we have got will require elements of debt restructuring and debt write-down, will probably require some permanent monetization, as well as requiring that we hit enough growth and at least positive inflation at the rate at the level of about 2%, so that the denominator is growing as well. I think a combination of policies will be required to deal with this very large debt overhang that we have.
You know, below your eloquence is really a very sharp view about a global financial system that is very, very different than the one that existed in 2008. So my question is, how would you envision, let's say that there is more or less a consensus begins to develop around some of the things that you're talking about. You know, the fact that finance can't be a free market. Sounds to me like a lot of people are realizing that. The fact that unrestrained growth isn't everything, and in fact steady growth is it's far more conducive to the welfare that growth is supposed to provide. The fact that price stability alone is not enough. How does this, the regulations you talked about in terms of making it so that much more unlikely that a big bank would go bust, how does this congeal into a financial system of the future? What is the mechanism? Do we need, for example, do we need another crisis to shock the system into kind of reaching another plateau? Or in your view, does this happen very incrementally and in large part because of the enormous interaction of people like yourself and others who have a lot of influence on the financial system and are probably in closer touch, exchanging more ideas than has ever been the case before? I'm trying to figure out a scenario in which a stronger financial system emerges, and how much of a step function that is, and how much it sort of just creeps up on us, or something else.
Well, I think we will make progress towards the financial system. I hope we can make progress towards a better financial system without another crisis. And we have better than in the past, but still imperfect mechanisms of doing that. I mean, I spent 5 years of my life as a regulator deeply involved with the international debates about regulation in the Basel Committee and the Financial Stability Board, where I chaired one of the crucial policy committee of the Financial Stability Board. And at one level, it was very impressive the way that post the crisis we got together and debated things like how do we have a higher capital standard, and this requires a lot of work. This requires a lot of 50, 70 people sitting around a large table in a windowless room in Basel for many hours on end and debating this through and grinding it out. And I think we can be quite proud that we've created some structures which pragmatically deal with the fact that we have a global financial system, but we don't have a global government, and we don't even, in the financial area, have a global treaty-based organization such as we have in the WTO to govern the mechanisms of international trade. So the tables that we're around in Basel Committee and what's called the Governors and Heads of Supervision meeting and the Financial Stability Board They don't have lawmaking power in the way that the WTO can effectively, agree stuff which has the force of international law. But we found ways of, saying we are all agreed that we'll do this, and then we ask the G20 leaders meeting to endorse it and say yes, do it. And I think that's an interesting bit of global governance development, which was evolved in a pragmatic fashion post-crisis, and it has achieved a lot. But it is still imperfect, because in those processes, on any one issue, there will be one or other country that thinks that its national interest or the particularly fragile position of its banking industry cannot yet deal with a higher capital standard without that being bad for the economy by making deleveraging worse. And therefore, the ability to actually make as much progress as you want to a really new robust system is imperfect. And I would say that through the mechanisms we did, we made a lot of progress, but not as much progress as we would want. Now, to my mind, what that suggests is I don't want us to make more progress through another crisis. So I think it's part of one of the reasons why, having now for a period of time moved out of that governmental sector into a role as a sort of intellectual commentator for now, I think there's a role for people like me to be sort of now guerrilla warfare for something more dramatic, an external pressure to say, no, we've got to go on to the next stage and the next stage. And I think that there's at least a reasonable possibility that we will find ways to just gradually ratchet in a gradual fashion. But it does mean, winning an intellectual argument and winning an argument that makes people realize that I think the core of the way to understand the danger of the financial system is the financial system left to its free market self can fundamentally produce too much finance. It can produce too much financial activity, too much trading activity, and in particular, too much leverage. Now, that's a very tricky thing for the financial sector to deal with. That's rather like facing fossil fuel companies with the reality of climate change, because it says that actually, in the interest of the world, fossil fuel companies, we don't want you to dig out of the ground all the fossil fuels you've got in your reserves. We want you to be a somewhat smaller business than you would like to be on a free market basis. And I'm afraid we do have to say that to finance as well, because I think that excessive leverage is as it were, it has an externality. It's a form of pollutant to the economy, in the same way that excessive production of carbon dioxide is an externality and a pollutant to the world. But that's very tricky, because there's a lot of good people who work within the financial services industry who would love it to be like the restaurant business or the hotel business, where as long as the consumers buy it, why would we ever place a limit on how much there is of it? But I think finance is different.
The ultimate irony, it seems to me, or maybe the paradox, not the irony, is that I love your analogy with the oil companies and climate change. But let me ask you, in finance, the sheer complexity of the way the system is connected makes it much harder, it seems to me, to put the constraints on it that you are talking about.
Yeah.
You mentioned the shadow banking system, but I think, and tell me if I'm wrong, one of the implications of what you're saying is that we need a corset of a kind that is nowhere near, we are nowhere near that yet. That is, we may be embarked on this. You can accept the notion that free markets don't work in finance, but the alternative is actually an extent of regulation that is nowhere near in sight, but it may have to be also a different kind of regulation. That is, you can't smother it. And so I know people like yourself and Andrew Haldane have tried to describe the actual nature of the system and sort of the need to think about regulation more in terms of regulating a complex adaptive system. And tell me if I'm wrong, but we have a long way to go to do that.
Yeah. Yeah, I think we have to recognize that we are trying to do a very, very difficult thing. We do have this very complex adaptive system. We want to constrain it, as you say. We want to, as it were, put a corset around its ability to fundamentally overcreate, to create too much credit and too many money equivalents. So you can think about the fundamental banking and shadow banking systems have the ability to create credit and to create either money or money equivalents. And we have to try to control that. But it is very difficult to do because the creation of credit and money equivalents is a very, if we control it in one area, somebody can create it elsewhere. Right. If I trusted you enough to sell you a product and you didn't give me cash, but you gave me a promissory note telling me that you would pay me in a year's time, and if the rest of the world, trusted you sufficiently that they thought that was good credit, I could then, use that as money to someone else. I mean, money comes out of credit. Credere, the Latin means to trust. Where there is trust, you can create money equivalents. Now, one of the huge problems we have in the shadow banking system, it reveals this, is, the thing is trusted for a period of time, because it appears to be trustworthy. People believe that these CDOs are really worth something, so they're worth something in the structured investment vehicles, and therefore the repo markets value them and the money market funds value them. And at the end of this chain is somebody with a money market fund mutual account who believes they got the equivalent of cash. But the moment the trust goes, this system can destroy the money and purchasing power that it created. And that process of creating it and then destroying it, is hugely disruptive to the real economy, as we saw in 2008. But because my example shows you that, the system has the ability to create money and credit equivalents outside the banking system, we mustn't fool ourselves that we can totally control this. What we can do, I think, is to place some limitations on those forces within the system that tend to drive the overcreation of credit and money. And I think one of the key areas where this happens is in the relationship between credit and real estate. When we allow people to lend a lot of money against real estate, which goes up in value because there's so much credit extended against it, in a way that then makes both the borrower think, oh, that worked, maybe I'll better borrow some money, and the lender to think, oh, that worked, I'll lend them some more money, we can get these amazingly strong cycles of the sort that Hyman Minsky described of credit, asset prices, more asset prices. And so I think we have to accept that part of what we need is central banks and regulators together looking at the development of some of these cycles and responding to them in a way that manages and controls them. But I think we would be wrong to fool ourselves that we will be able to do that by writing down in advance a set of rules which are static and forever and do the trick because they're static and forever. I once read somebody say, I can't remember where it was, that any defined static set of financial regulations will be arbitraged by the system within about 3 years. People don't like this because regulators like the certainty, governments like the certainty of saying, well, show me the rule book which will make this thing permanently safe. Because this is a complex adaptive system which can adapt to create credit and money, we unfortunately have to have a system where the regulators and the central banks are continually watching the development of this system and changing the tools and the controls to try and stop it running out of control.
Well, that's a great place to stop. I want to thank you very much. That was extremely interesting, and I wish you really the best of luck in stimulating so many people to think in a different way and to come at these issues from a different angle. I think it's a great public service. I never thought of public service that way, but watching you, I can see there are various sectors. There's the actual public sector. There's of course the private sector. You've been in both. There's something in between well, people operating from think tanks or NGOs, and then there's just sort of the intellectual prodder who's prodding people to think. And I think it takes somebody with your background to be both radical and credible. And it's a real honor to have talked to you about these things.
Well, thank you very much.